The Bank of England is migrating its entire RTGS payment infrastructure to ISO 20022, and it has not created a single digital currency. That's not a failure, but a signal that most investors are analyzing the wrong layer of the financial stack entirely. ISO 20022 is a messaging standard, not a settlement layer. It standardizes how payment instructions are described, not how value is transferred or when obligations become final. And if your CBDC strategy treats messaging adoption as digital money progress, it's broken at the foundation, the messaging trap. So let's be clear about what ISO 20022 actually is and what it actually does. But first, we need to understand why so many people are making the same mistake. The conflation happens because the same institutions are using the same language. Central banks announce payment modernization. Vendors sell digital transformation, press releases, talk about interoperability and next-generation infrastructure. And all of it sounds like progress toward digital currency. But most of these announcements are about messaging, not money. The Bank of England's RTGS renewal program is a good example. It's migrating payment and non-payment messages to ISO 2022. Statements, notifications, reports, and transaction instructions will all use richer, more structured data. This is real infrastructure work with real benefits. But the pound, sitting in the Bank of England's settlement accounts, is still the same pound. No new digital currency was created. The European Central Bank's T2T2S consolidation does something similar. It's replacing the old Target 2 RTGS system with a new T2 platform that uses ISO 20022. Cash and securities settlement services are being integrated. The data architecture is getting cleaner, but the euro itself hasn't changed form. This is a messaging upgrade wrapped in modern language. Vendors of message translation and orchestration software benefit directly from this migration. Their business model depends on richer data moving through existing pipes, but those pipes still lead to the same central bank accounts and the same RTGS platforms. The money underneath hasn't changed. This is the trap. When a central bank announces an ISO 20022 migration, the natural assumption is that digital money is coming. But the announcement is about how instructions are described, not about what is being transferred or how finality is achieved. The two layers, messaging and settlement, are being treated as one thing because the marketing uses the same words. The distinction matters because capital is being allocated on the assumption that messaging adoption equals monetary innovation. Investors are watching ISO 2022 migration timelines and treating them as proxies for CBDC progress. They're not the same thing, and confusing them means you're tracking the wrong signal entirely. Part 1. ISO 20022 is just the dictionary. So the real question becomes this. If ISO 2022 isn't digital money, then what is it? It's a unified modeling methodology for financial messages. The standard provides a common data dictionary so that different systems can describe payment instructions, counterparties, compliance flags, and remittance data in the same way. Think of it as a dictionary that every bank and market infrastructure agrees to use. The words get richer, the grammar gets cleaner, but the dictionary doesn't move value. It only describes the instructions. This methodology is more than a fixed catalog of message types. Different communities, payments, securities, and trade finance can define message sets based on shared business processes. The data elements map to standardized definitions, while keeping enough flexibility to handle new requirements. So a payment message from London and a securities instruction from Singapore can carry the same structured meaning, even though they settle through completely different systems. The language aligns, but the ledgers underneath do not. The benefits are real. Richer data improves sanctions screening because there's more context about who is sending what and why. Reconciliation gets easier because the messages carry more structured remittance information. Exception handling improves because the data is machine-readable and more predictable. And cross-border interoperability becomes simpler because more jurisdictions are speaking the same financial language. Ripple has highlighted exactly this potential in cross-border payments. By standardizing data elements, ISO 20022 enables more automated compliance and faster reconciliation. That supports quicker, more transparent international transfers. But notice what is happening here. The transfer still runs through existing correspondent banking relationships and existing central bank settlement accounts. The message got better, but the settlement didn't change. The Bank of England and the European Central Bank are proving this at scale. Both are running major RTGS renewal programs that use ISO 20022 as the core messaging interface. These projects require significant changes to back-office systems, data models, and compliance processes. They're not cosmetic upgrades, but they are upgrades to the language layer, not the money layer. The central bank liabilities sitting in settlement accounts remain unchanged. From an investment standpoint, this means that vendors in message translation, orchestration, and analytics are well positioned. They will capture value from the broad migration of payment infrastructure to richer data standards. But their business models generally stay within the existing paradigm of bank accounts and central bank RTGS systems. The messaging becomes more algorithmically exploitable, but the settlement assets do not. So here's the distinction that matters. A message can be perfectly formatted, richly described, and instantly transmitted, and still not settle. The message tells the system what to do. It doesn't determine when the obligation is discharged. And that gap between a well-formed instruction and a final transfer is where the real risk lives. Part 2. Settlement. Finality is where risk actually lives. Settlement finality isn't a technical property of the message. It's a legal and operational concept that determines when a payment or transfer becomes irrevocable and unconditional. At that moment, the obligations between parties are fully discharged and can't be unwound except through an entirely new transaction. This matters because risk lives in the gap between sending a message and achieving finality. You have two counterparties, two systems, and a space between when each side fulfills its obligation. That space is where credit risk and liquidity risk accumulate. If participants cannot know with certainty when a payment is final, they face unexpected exposures that can propagate through the system and undermine trust. The European Union recognized this explicitly in the Settlement Finality Directive. The directive protects transfer orders and netting arrangements in designated payment and securities settlement systems. Once a transfer order reaches specified points in the processing flow, it can't be revoked, not even in insolvency proceedings against a participant. The directive also clarifies which law governs the rights and obligations associated with securities held in these systems. This reduces uncertainty in cross-border contexts where multiple legal regimes might otherwise conflict. The key point is that finality is anchored in legal statutes, system rules, and technical architectures that govern how entries on accounts or ledgers are updated and recognized as definitive. An ISO 20022 payment message might contain rich data about the transaction, its purpose, counterparties, and compliance flags. But the moment of finality is determined by the underlying system, the central bank RTGS platform or the securities settlement facility that executes the transfer in accordance with its rules and governing law. ISO 20022 can improve transparency and automation in the process leading up to settlement. It can help with post-settlement reporting and reconciliation. But it doesn't itself confer finality. It doesn't close the gap where risk lives. The Bank for International Settlements and the Committee on Payments and Market Infrastructures have been clear about this. When stablecoins, CBDCs, or institutional DLT platforms are used for critical payment functions, they should be judged against the principles for financial market infrastructures. These principles require robust settlement finality, clear legal rights, and strong operational risk management. The technology can be novel, but the standards for finality don't relax. And this is where a lot of projects fall apart. They have elegant consensus mechanisms and beautiful white papers, but no statutory framework that makes a ledger entry legally binding. For an investor, evaluating the robustness of a CBDC or DLT project involves more than checking its technical features. You need to understand its legal and governance arrangements for finality, insolvency protection, and conflict of law issues. A platform with sophisticated cryptography but unclear statutory backing is an experiment, not infrastructure. And experiments don't earn institutional adoption at scale. Now, keep that in mind because this is where CBDCs and DLT platforms enter the picture, and this is where the marketing gets deliberately blurry. Part 3. On-ledger reality, what CBDCs actually change. CBDCs and institutional DLT platforms introduce something that ISO 20022 migrations don't. They introduce a new form of money or a new settlement asset recorded on a ledger. This is an architectural change, not a semantic one. A retail CBDC, for example, involves processes that don't exist in traditional banking. Users must be enrolled, identities verified, and wallets provisioned. Cash in allows conversion from bank deposits or physical cash into CBDC units. Cash out allows conversion back. Intra-ledger transfers move CBDC units between users within the system. These aren't messaging improvements. They are new monetary processes built on a new instrument. The Bank for International Settlements has examined this architecture in detail. Its proposal for a retail CBDC highlights 4 core processes that define how the system functions. Each process requires design choices about whether the CBDC is token-based or account-based, whether commercial banks or payment service providers handle customer-facing functions, and how privacy and data protection are managed. The design must balance efficiency, security, financial stability, and policy goals such as inclusion and competition. These are strategic decisions about the nature of money, not upgrades to how instructions are sent. On the wholesale side, projects like mBridge explore a shared multi-CBDC platform for cross-border settlement between central banks. This is about creating a common settlement layer where different sovereign currencies can interact on a single ledger. Finality aims to create tokenized settlement assets backed by central bank money within jurisdiction-specific payment systems. Both initiatives are about the asset and the ledger, not the message format. The technical difference comes down to this. One approach updates the language used to describe transfers of existing money. The other creates new instruments and new rules for how those instruments settle. They're not the same category of project, and they don't carry the same risk-return profile. But technical capability alone doesn't guarantee adoption. Nigeria's eNaira provides a clear warning. The eNaira was launched to promote financial inclusion, increase efficiency, and modernize the payment system. It's got technical programmability and functioning infrastructure. Yet adoption has remained modest relative to the country's population and economic activity. The International Monetary Fund evaluated the eNaira after its first year and identified why. Competition from existing mobile money and fast payment services already provided convenient digital options. Public awareness was limited. Trust and usability concerns persisted. The conclusion was stark. Without compelling incentives or unique features relative to existing solutions, a CBDC may struggle to attract users even when the technology works. This is the other side of the coin. A messaging upgrade without monetary innovation is incomplete in one direction. A monetary innovation without ecosystem fit is incomplete in the other. The strategy breaks when you treat either one as the whole picture. Synthesis. Why the stack collapses without all 3 layers. So let's put these 3 layers together and look at why most strategies collapse at the junction between them. The first layer is messaging. ISO 20022 standardizes how instructions are described. It improves interoperability, compliance, and reconciliation. It's necessary infrastructure, but it doesn't create new money. The second layer is settlement finality. This is the legal and operational framework that determines when a transfer becomes irrevocable. It closes the gap where counterparty risk lives. Without it, even the best messaging can't create a safe payment system. The third layer is on-ledger assets. This is where CBDCs and tokenized settlement instruments introduce genuinely new forms of money. They change what is being transferred, not just how it is described. A strategy that bets on ISO 20022 adoption as a proxy for CBDC value is broken because it's tracking the first layer and assuming progress on the third. The messaging upgrade is necessary, but not sufficient. It enables a future CBDC to be more interoperable. But a CBDC could theoretically exist without ISO 20022 and ISO 20022 adoption proceeds at many central banks with no CBDC commitment at all. Fast payment systems illustrate this gap perfectly. Many jurisdictions have introduced fast payment infrastructures that allow near instantaneous transfers between bank accounts, often operating around the clock and using modern messaging standards. These systems deliver user-facing speed and convenience, but they don't change the underlying monetary architecture. The money moving through them is still traditional central bank liabilities and commercial bank deposits. The Bank for International Settlements has noted that some central banks view fast payment systems as an alternative or complement to retail CBDCs. The user experience is similar, but the architecture underneath is not. So observing fast payment modernization is not the same as observing a move toward digital currency. The distinction is structural, not cosmetic. Nigeria's Naira shows what happens when the third layer exists without the second and first layers fully aligning. The monetary innovation was real, but the ecosystem fit was not. The United Kingdom's RTGS renewal shows what happens when the first layer advances without touching the third. The messaging is modern, but the money is unchanged. Both are incomplete if your strategy conflates them. The aha moment is this. Most announcements use the same words: digital transformation, next-generation infrastructure, modernization. But those words can mean three completely different things. You need to evaluate every announcement across all three layers. Is this richer messaging, faster settlement of existing money, or new settlement assets? Each has a different timeline, a different risk profile, and a different set of beneficiaries. Treating them as a single trend means misallocating capital and misreading the signal entirely. Takeaways: what to track instead. So if you're trying to separate signal from noise in this space, here's what actually matters. When a central bank or infrastructure announces a digital initiative, ask which layer it targets. Is it richer messages, faster settlement of existing money, or new settlement assets? Messaging vendors, incumbent RTGS operators, and tokenized settlement platforms don't benefit equally from the same announcement. Each layer has a different risk-return profile, and your allocation should reflect that. Look for legal finality frameworks, not just technical white papers. A DLT platform without statutory settlement finality or alignment with the principles for financial market infrastructures is an experiment. Experiments are interesting, but they aren't infrastructure. The transition from pilot to production depends on legal recognition, not just consensus algorithms. Distinguish fast payment modernization from CBDC issuance. Many jurisdictions are achieving user-facing speed without changing the monetary architecture at all. That is a payment upgrade, not a currency innovation. Do not read fast settlement as a signal of deep transformation unless the underlying asset itself is changing. If this kind of structural analysis is useful to you, subscribe. The next breakdown covers why the repo market's collateral pressure makes DLT settlement a survival mechanism, not a choice. Thanks for watching.